But Rod, I'd love to just start off with your take on this report, based at least on the data that you collect regularly in terms of trying to assess demand.
Yeah, good morning. Well, we get these reports often, and I think I heard somebody say earlier, I don't get a phone call from the suppliers telling me what's happening with Apple. I think we have to take all these things with a grain of salt. And let's say it's true. It's hard to interpret these tea leaves in this environment with the supply chain so tight. And, in a normal year, I would say this would be a likely negative demand indicator. In this year, I think it's very tough to tell.
And that is because what? I mean, the idea that Apple perhaps may have ordered more than it necessarily needed just to make sure it had the chips it needed on hand?
Yeah, they may have over-ordered. Typically they will over-order in any year. This year, they probably over-ordered by more. So supply chain reductions may be an indicator of negative demand, maybe not. I would say that our own panel, we do our own looking at lead times for iPhone across the globe. That has suggested demand may be weakening. Lead times are always the balance of supply and demand. We've seen China lead times come in faster than we thought they would. We've seen U.S. lead times come in faster than they thought they would. And then this latest week, which we just published, we saw the UK and Europe come in by about 7 days. So, lead times are suggesting that demand has been a little bit weaker than we might have expected. The iPhone 13 Pro in particular has lead time data that's quite a bit lower than it was last year. And you would have thought with supply shortages, that would have been the other way around. In fact, the only iPhone that actually still shows elevated lead times is the Pro Max. So, that data suggests that demand's a little bit weaker, but again, very tough to tell in this environment.
Right. Well, is it weaker? I mean, I also see you say demand coming closer to equilibrium. I guess just to try to understand where you think we're going to end up here in terms of sales during this important period that we're in right now.
Yeah, let's take the iPhone 13 Pro, for example. If you're short of supply in this environment, which I think we all assume that they are, and your lead time this year is lower than last year, then you're probably concluding that demand there is weaker than it was last year. Okay, so that just logically, that's where you're going to come out. If in the case of the other devices, your lead times are pretty similar to last year, there it's less clear because you don't know how much supply has come up to meet demand. So I would say that, on the margin, the data suggests that demand's a little bit weak here. But I think it's very difficult to tell, as you can tell by the way I'm talking about it.
Difficult to tell exactly how weak, perhaps. Even with the sell-off this morning, Apple's still trading about 11% above your price target. Would you urge investors not to buy on today's dip?
Yeah, we're neutral as stock. I mean, if we wanted people to buy on the dip, we'd be buyers. I think that our view has continued to be that the number of subscribers that Apple's got, the number of users out there, that growth rate is slowing to GDP growth. And the ARPU, the revenue per user, headed into COVID was flat. It jumped by over 20% in COVID. It's likely going to normalize at a lower level from here. Very tough for Apple to grow earnings and revenue in that scenario. So, yet the stock is priced at a significant premium to the S&P 500. So, yeah, we don't think people should be buying this stock in that, given all of those data points.
So, Rod, neutral rating here. What would make you feel otherwise, particularly in light of the fact the stock has obviously moved up to perform in line, frankly, this year with the S&P after underperforming much of the year?
Yeah, and by the way, inline performance is neutral. So that's done exactly what we thought it would, and it's very consistent with our rating. To get more constructive, I would want to see some evidence that ARPU is holding up the way the street thinks it will at levels that we saw in COVID, that we believe were driven by the lockdowns and the fact that consumers just had a lot more money to spend because they weren't spending it on restaurants and travel and things like that. If I were going to get more cautious on the stock, I'd want to see the ARPU undershooting me or significantly undershooting the market. So that's kind of the way we think about the stock. We're looking at that ARPU, we're looking at the trajectory of the ARPU, and then we make our calls accordingly.
Okay. Rod, always appreciate your insights. Thank you.
Yeah, thank you.
Shepard Smith here. Thanks for watching CNBC on YouTube.